All right, good morning all, and welcome to this special Zoom call where we are going to we're going to try and simplify the whole process of options trading. I know everyone's kind of overwhelmed by the whole thing, and we'll obviously talk a little bit about stock trading, which is really what good options trading is really good stock. But Mitch is going to go through our process and how we deliver this information to you guys the whole night. You're going to get a full-throated um, breakdown on the right way to do this. So in a second here, Mitch is going to get rolling. He's going to have the disclaimer up here for your protection and ours, and then he's going to roll through some previous trades or recent trades that we've had inside of our community, and then he'll start breaking down some charts. And if you feel if there's some symbols you're tracking or that you like to look at, feel free to pop it into the chat, and we'll use that as part of the presentation instead of just stuff we want. I'd rather answer you guys' questions and spend a lot more time interacting than I would just us blabbering the whole time. But feel free to throw that in the chat, and I'll do the interrupting of Mitch because I get to see that. And without further ado, let me turn this over to my business partner, Mitch Firestone, and we'll get rolling.
All righty. Good morning, folks. My name is Mitch Firestone. As Ryan said, I am his business partner here at PTL. Ryan alluded to what we're going to go through here, but here's a kind of a formal kind of a summary here. So we're going to talk in no particular order, and we'll kind of mix and match here. But we're going to talk about kind of how we deliver information here. In terms of our program here, and then we're going to talk about how we essentially set up a trade. What is the kind of the foundation for our trading? As Ryan said, we're going to specifically talk about options and kind of what makes them tick. And I think we'll also talk really directly about kind of the mistakes of the approach that lots of people make in doing options. And we're going to try and show essentially how what we bring to the table and what we teach is a way of kind of avoiding those mistakes. So we're going to talk about all of that. As Ryan said, we'll also look at some examples to kind of see how this stuff works. And importantly, we're going to show how it works. We're also going to show what happens when it doesn't work. This is trading, and trading is a matter of probability. And so as a result, if you're a superstar and you're right 60 or 70% of the time, and you're kicking butt, that's awesome. That means that you're supposed to be wrong 30% of the time. So we're going to show you how we handle things and how we set things up so that that 30% doesn't decimate the other 60 or 70% that happens when we're right. And then lastly, we'll also kind of just go through essentially how we kind of all piece all this stuff together and how that it's an intuitive, simple, not easy, but a simple methodology with not a whole lot of moving parts to it. I'm sure we've all seen, people post things that what we refer to as spaghetti charts with 15 different indicators and curves and everything else. We generally avoid all that stuff, so we're going to talk about all of that. All right, so that's kind of the game plan here. Before we get going, as Ryan said, the usual disclaimer, everything we're about to present here is for information and educational purposes only. None of this is investment advice. We are not financial advisors, nor are we money managers. So there you go. All right. So what I want to do here is I'm going to start out by kind of just showing some prior trades. And then as I'm showing these prior trades, I will talk about what the foundational principle of what was behind it. And then we'll kind of go from there. And then essentially you'll then have a kind of the foundation of what we're all about here and what we kind of do here. All right. So, and we're also going to look at a mix of both. We're going to look at some swing trades that go on for several days or even a couple of weeks. And we'll also take a look at some intraday trades to show you that essentially the principles that of how we create trades and how we trade, they really apply to all styles and all time frames. So again, they can be used on an intraday basis. They could be used for a short term, let's say trade that goes on intra-week, within a week, and it could also go on with something that, let's say, goes for 2-3 weeks or a month even, and anything above and in between. So that's kind of the game plan here. So I figured I would start out here and just kind of show you, let's say, a particular some trades that we actually had here, and that we went through here. And so here is something that we had kind of posted here. And this all goes, and incidentally, I will show you in a few minutes the form of how this actually gets posted for our subscribers. But what I'm going to do right now is I'm just going to show you these slides, but then I'll eventually show you essentially how things actually get posted and disseminated to our subscribers and our fellow traders. So here is a daily chart of a Carnival Cruise Line, okay? And so this was something I had been looking at in the middle of the summer here on August 14th here. This is a daily chart. For those of you who are very new at this, of course, each price bar here, of course, represents exactly 1 day of trading, okay? And we have the open, high, and low and close. Of course, I'll show you some intraday trades in a few minutes, and then we're going to be looking at 1, 2, and 5-minute charts, okay? But all of the principles that I'm going to show you, you're going to realize it all happens in the same way, all right? So this is a daily chart we were looking at, what I was looking at for Carnival here. And if you notice that there are a couple of regions that are shaded here. And these are the regions that Ryan and I have some confidence that we actually know what's going on in the chart. And that we have an idea that if and when price gets to a particular area in the chart, that is where we're going to actually enter a trade. What we're going to do is we're going to express a trade. And we can express a trade from a region in any number of ways. We can either we can either buy stock or short stock, or another way, of course, to express the trade would be in a case where we would buy stock. Rather than buying stock, we would buy a call, of course, which is a bullish proposition. Similarly, if there's a place where we would short stock, this is where, of course, we would buy a put. Okay, so that is what we're looking at here. This is a place up here where we would anticipate that if price got up to here, this is where we would either short or we would buy a put. Down here is a region where we would either buy stock or we would buy a call. Okay, so those are the two ways we could express a trade. Also, for people that are into options, there are other ways, of course, one can express a trade. One could, of course, also sell a credit spread at a particular region, and then essentially what you do, of course, is collect premium. And so right here, rather than buying a call here, one could also sell a bull put vertical credit spread. And then up here, one, of course, could sell a bear call vertical credit spread. And that would be a way of collecting premium. Okay, but in this region, we're expecting price to drop. And in this region, when price returns here, we expect price to pop, to bounce. Okay, and so if you notice right here, what the reason that we chose these two regions is that this is an area which experienced what we refer to as a sudden exhaustion of sellers. Okay, within this narrow region here of about 90 cents here, from about 12 to about 12.90, okay, notice price kind of consolidates, it bases, it goes sideways, okay? And then notice then right here, there is a gap and price kind of pops from there. And then there's a little pause and then price rockets out of there. So this essentially was the launch point of an explosive bullish move. Similarly, over here, this was an area of consolidation where this was the launch point for a very, very bearish move here. Okay, so these are the regions that essentially where we feel we know what's going on here. Okay, right here we had an area of explosive upward price pressure here. Okay, and so when price returns to here, based on the structure of this zone and how it left, we anticipate that there is still a positive upward price pressure that's waiting to be tapped when price returns to this region. Similarly, over here, where there was an exhaustion of buyers, when price returns here, we expect that in fact that there is going to be another round of selling when price returns here. Okay, if we think of the shares that are acquired by buyers, we can think of that as the demand for shares. Okay, if we think about the shares that are offered up by sellers, we can think of that as the supply of shares. Within this region, okay, then, okay, the buyers and sellers, the supply and demand for shares, they're all traveling within this relatively narrow region. And then right here, where there's an exhaustion of sellers, where no one is willing to sell anymore, what's going on here is essentially is there's no longer any supply of shares here. Okay, there is only now left demand. And hence, because of the fact that where supply and demand were in balance here, and then it goes out of balance here by this exhaustion of sellers, we refer to this now as a demand zone because in fact there is only demand left in here. There was supply and demand, but now once price leaves here, there is only demand left. There is no longer supply. And when price returns to a demand zone, that's where we express a bullish trade. Okay. Similarly up here, okay, again, supply and demand are in balance. We have this exhaustion of sellers here, excuse me, the exhaustion of buyers. And so when there's the exhaustion of buyers, there is no longer any demand up here. There is only supply. Hence, we refer to this above current price here as a supply zone. When price returns to a supply zone, that is where we express a bearish trade. And that's where we either short or we buy a put or we sell a bear call vertical credit spread as examples. Okay. So when price returns here, that we're expecting price to drop. When it returns here again, and this is where we expect it to bounce. Okay. These are the two areas in the chart that Ryan and I feel that we have a pretty good idea of what's going to happen a fair percentage of the time. Okay. Now, what it's going to do in between here, I'll be honest with you. At the time I was looking at this, I hadn't a clue. Okay. I do not know what this thing is going to do in between. It's certainly in a downtrend at that point, and that's kind of what I was anticipating. But I would never just automatically short here or express a bearish trade just because it's in a down wave, okay? Because it's just going to bounce around. But when it gets here, I'm expecting a bounce. When it's here, I'm expecting it to get pushed down, okay? These are the areas that I have some confidence about. Okay, but to be clear though, it's trading. And consequently, when it comes to trading, it's all about a probability function. And so as a result, I don't just automatically assume that I'm going to be right. Okay, and so right here, this is where our entry would be at this region. Okay, and on the other hand, this is where we would say if it plows through this region and it goes a bit below, this is where I would be wrong, and this is where I would get stopped at on this trade. Similarly up here, this is where we would get into the trade, and this is where we would get stopped out. So in all cases, we're managing our risk. Okay. Lastly, if we look at this ladder here, we will see, in fact, that there are these rungs of the ladder. Each one of these rungs of the ladder represents one unit of risk. Okay. We can see right here that we have exactly $1 of risk here because the entry and the stop out point are precisely $1 apart here. Okay, and you can see right here so this would be a 1-to-1 trade. You'd make $1. This would be a 2-to-1 trade. You'd make $2. That you'd make $3. That's a 3-to-1 trade here in terms of its distance. Over here, if we were going to short, okay, the distance here is about 50 cents, 52 cents to be precise. Okay, and so as a result, each unit of risk here is exactly that amount is exactly that amount here. Okay, so that's 1-to-1, that's 2-to-1, that's 3-to-1, same that I showed you here, except the unit of risk here is 52 cents rather than exactly $1. Okay, so that's how we manage our risk. Okay, all right, so that's how that was the setup for this trade. Okay, and so now we were waiting for either price to return to this region or to rally up to that region, and these would be the two areas that we would actually express a trade. Okay, so now if we flash forward, okay, we can see right here price in fact rallied up to this region here. Again, this is the region that I was showing you here, back here. Now things are a little more compressed because I wanted to fit everything in. But there's that lower region, there's the higher region, and you can see now price in fact rallied up to that higher region. Okay, at that point, the way we expressed this trade was to buy a put. Okay, so at the time we did this, um, this was sitting at around in August here, and so we ended up buying the October 18th expiration put. Okay, so that was about 2 months, a little less than 2 months distant here. Okay, and so we basically bought the 18 strike put. Okay, why do we buy the 18 strike put? Because essentially what we did was when price returned here, if we bought the 18 strike put, that would mean we would be about $1 in the money. Okay, and so when you're $1 in the money, if you know anything about options, you're running a delta of, let's say, if you're running, let's say, $1 in the money. Okay, $1 in the money on a $17 stock, it means you're about 6% or so in the money. Okay, well, if you're running about 6% in the money, you're generally going to be running a delta of somewhere around 55, 57, maybe even 60. Okay, and so as a result, what we do is we buy something that's a bit in the money so that essentially we're going to be rewarded if in fact we're right. Okay, you don't want to buy something where you're, let's say, running way out of the money. You're running a delta of 15 or 20 because, yeah, you could buy the option really cheap. But on the other hand, if you're buying really cheap, even if you're right, you're not going to make anything, or you'll hardly make anything. And that's actually one of the big mistakes that people do, is that they try to put on these option trades, and they try to do it on the cheap. Okay, one way they do it on the cheap is they buy them way out of the money. Okay, so in other words, like if you're buying the SPY and the SPY is sitting at 500, people are buying like puts, like, let's say buying calls if they're going to, let's say, express a bullish trade, and they buy like the 540 call or something when the SPY is sitting at 500. And yeah, you could buy the option for like 75 cents or whatever it is. But that's like buying a lottery ticket. Okay. And then the other way people also try to do options on the cheap is they buy very little time. Okay. And so, lots of people, they like to do zero DTE options. And in fact, one can do short-term options, but even if you're going to do a zero DTE option, you're better off buying, let's say, 3 or 4 days as opposed to 1 day of time. And I'll show you the example in a second of how that plays out. Okay. So at any rate, though, so what we did was we were value shoppers in terms of buying time here. Okay. We didn't buy time for like 2 weeks, even though we knew we were only going to be in the trade for a short amount of time once it got here. Um, okay. Well, we decided that we were going to buy, let's say, something that's roughly about 2 months out, so that if in fact we get stuck in the trade, we're not going to be stuck in the trade and getting crushed by time decay. Okay, so that's why essentially this is like being a value shopper. Okay, even though we spend a little more on time, we're going to get that money back once we actually once we close out the trade. Okay, it's like being a value shopper. You could go to a big box store and you could buy either a Samsung, 55 or 60-inch flat screen TV. Okay, and you could pay $600 for the Samsung, or you could pay $475 or $450 for the house brand of the big box store. Um, if you buy the Samsung, you're being a value shopper. Yeah, you're going to pay an extra $150, but you're getting a Samsung as opposed to the big box, private brand. Okay, it's the same thing here. You want to be a value shopper when it comes to time, because ultimately you're going to get rewarded for it when you go to close out the trade. Okay, so at any rate, this is where we got in. We got in on the okay, right here, and so we basically got in paid $1.65 at when this thing was at 17.10. Okay, so we bought this a bit in the money here. We bought the 18 strike put. Okay, and then over time. Okay, so we were in this trade now. Basically, we were in the trade for about what is that? About 5, 10, 12. That's about 12, 10 or 11, 12 trading days. And you can see that actually in terms of calendar days, That took us out for, what is that, 4? And yeah, we're in this about 10 days or so. In fact, actually, that's where we got out right there. Okay, so we got in there, we got out there. Okay, and so essentially, then this thing rose from $1.65, went up to 260. Okay, we made about a buck on that. And in terms of a percentage, obviously running from $1.65 to basically making a buck. Okay, that was a 58% gain on that. Okay. And so that's essentially how these trades kind of play out when they work. We have a supply or a demand zone. Price returns to those, and essentially then what we do is we put on a call or a put, and then we essentially ride that thing, a certain distance, and then with that, then we of course close out the trade. On the other hand, if this thing didn't work here, and let's just say it plowed right through, we would have gotten stopped out right there. And then at that point, if we got in at $1.65, we would have lost, depending on how long it took, we would have lost, 30 or 40 cents or something like that. Depends on, as obviously the longer the trade takes to get stopped out, or for that matter, to achieve a profit, the longer it goes on, obviously you're going to get hurt by time decay. Except when you buy enough time, you only get hurt a little by time decay instead of a lot. Okay. So, and you can see right here, when price came down here, we actually, even though we didn't take another trade here, you can see this thing actually bounced right off of this demand zone here. So in fact, had we been either alert or just decided we were going to put on another trade, one could have actually taken another trade and put that on right here, because in fact it did exactly what we expected it to do. All right, so that's kind of a sort of an overview of kind of how we set up these trades here. We identify these areas where supply and demand go out of balance. Okay, and then what we do is we then again express a bearish trade at an area of supply, and we express a bullish trade out of an area of demand, like here and there, and right there is an area of supply. Okay, so that's kind of the general principle here. So what I wanted to do here now is I was going to bring up and talk a little bit more about time decay, because I mentioned a couple of minutes ago that this is a mistake that people make. They essentially don't buy enough time. And in fact, one of the things that we hear from our subscribers all the time is that they will put on a trade. In a sense, they're right about their proposition for the trade. In other words, they think something's going to go up. They think something's going to go down. They buy a call. They buy a put. They're right. The underlying does kind of what they anticipated it to do. And then they look at their option position and it sucks. They're losing money, and they're like, well, I don't get it. So here's one of the reasons why. And then I'll kind of show you, and then essentially kind of show you then how this kind of plays out here. So bear with me one second. Let me bring this up here. So in terms of time decay, okay, time decay, of course, is the drag on your trade. You buy a call, you buy a put, it's got the time value, it's got its value of how much it's in the money. So you may buy an option, it's worth $5, okay, okay, but it's, let's say, $3.50 in the money, and yet the option costs $5. Okay, so the 350 is how much it's in the money. That's what's referred to as its intrinsic value. But then there is its extrinsic value. And the extrinsic value essentially is time value. It's all the money, it's all the value of the option that's in excess of how much it's in the money. Okay, that's your time value. Okay, and of course, time value is not constant, because it depends on if you're close to earnings, if you're far away from earnings, and then it also depends on how close or far you are from expiration. Okay, and so this is kind of the deal of how time decay works. And just imagine that you've got 90 days to do a project. Okay, well, the value at the end of a week, the first week, after 6 or 7 days passes, one day is worth about 1.2% of how much time you have left to go. Okay, so it's really not worth a whole lot. Okay, now imagine 30 days later, you've got one day to go, out of 54 days. Okay. Now all of a sudden, the value of in terms of how much that option represents in terms of time, now it's about 2%. So it's it's still it's obviously increased, but it still hasn't increased a tremendous amount. Now notice if you go out another 30 days, okay, all of a sudden now the value in terms of how much time you have left, now all of a sudden that one day is about is over 4%. Okay. Now you go out another 12 days. Okay. And now one day represents 8%. Okay. And then you can go all the way down to expiration. And you can see as you get closer and closer to expiration, each day is worth more and more proportionally of how much time you have left. This is how time decay works. Okay. And so if we actually look to see kind of how is this depicted here, okay, again, the value increases at an accelerated rate. Okay, right there you can see because it goes up 2.5%. Here it goes up another 4%. Here it goes up 6%. Okay, you can see it accelerates. Okay, so if we think about time decay, okay, if you didn't know any better, you'd be looking and go, okay, well, you have this much time at the beginning here, and then when you get down to weeks to day zero, when you got to expiration, well, then that's of course going to be zero, and so you connect the dots, and that would be the graph of time decay, right? And of course, that's not exactly that. Of course, that's not how time decay works, because in fact, time decay looks like this. Okay, you start out up here, some time passes. Okay, in terms of the time value of your option, okay, you're not really losing a whole lot, okay, as you start to kind of go. But then as you get closer and closer to expiration, okay, notice this thing starts to kind of really curve down. Okay, and if we think about how it curves down, we can think of essentially the slope of that line. Okay, and so this is how time decay looks as time goes on. Okay. Okay. So in other words, right here, this is the beginning, that's the middle. Okay. And then when you get to the end, so we can think of this as kind of like almost like the bunny hill on a ski slope. And right here, this is kind of like the diamond hill or the extreme skiing down here. Okay. And so up here, time decay is not hurting your trade too much. Down here, it's destroying your trade if in fact you're buying an option. Now, of course, and this is why I have this little caption up here, theta, which represents time decay. And then I go, well, theta, friend or foe? Okay. And of course, being a wise guy, I go, yes, because it depends. If you're buying options, the time decay is your enemy. On the other hand, if you're selling options, okay, when you get down here, time decay is your friend. Because if you sold a credit spread, then you're kicking butt probably. As long as the price has not moved too much, you're collecting on time decay here because time decay is eroding very, very quickly. Okay. And so in terms of option strategies, okay, you're much better spending a bit more on your option and buying enough time, okay, so that if you're in the trade for a bit of time, you're not getting decimated by time decay. On the other hand, down here, this is where you really want, with shorter duration, you want to be selling options, okay? Because right here is actually where you're benefiting from time decay, okay? And so that's kind of represented here, okay? Because basically the time is cheaper up here and it decays slower, okay? Right here, okay, basically it's more expensive, okay, and it's also the value decays faster. And when I say cheaper, I'm talking about, let's say, on a per day basis, okay? So up here, you're going to be paying more in the aggregate for time, but you're going to get it back though once you close the trade, okay? So that's kind of the little wrap on time decay, and this applies for whether you're doing let's say whether you're doing a swing trade, or even if you're going to do a very short duration trade, let's say something like, oh, I'm going to buy an option out and I'm going to get in on Monday, and I want to either get out like tomorrow or on Tuesday or Wednesday latest, or even I'm going to be in for for like 2 or 3 days. You're much better off spending a little more and at least buy 5 days of time, okay, rather than one day of time, okay? And of course, for a lot of things, you can't do that. But if, let's say, you're trading the SPY, for instance, and you're buying options on the SPY, yeah, you're much better off buying, let's say, an option that say like 2 or 3 days, or 5 days or 4 days, depending on when you do this, of course, um, in terms of expiration, than buying the next day or even that day. Because really, it's a very, very difficult trade. Okay, you're making your life really difficult, and it's almost like a lottery ticket. Okay, and how often do lottery tickets hit? And this is actually how a lot of people trade. Okay, they buy their options with very little time, and they buy them way out of the money. Okay, and that's just like a deadly combination. Sure, here and there you're going to have a winning trade, and you're going to look like a hero, and you're going to feel like a hero. My God, I got like, I made like a 15x trade. Okay, I paid 25 cents, and I closed it out for 250. I'm a freaking hero. The problem with that is you forget all the times of all the money that you waste. Okay, it's kind of like playing poker. Okay, if all you do is draw to inside straights, sure, 1 out of 13 times, you're going to fill in your straight. Okay. What about the other 12 times? Okay. And, unless you're, getting paid off an absurd amount for the one time that you hit your inside straight, that hitting the inside straight once out of 13 times is not going to pay for those 12 losers. Well, it's the same thing here with options trading. You can take that lottery ticket mentality, and of course, there are times that you're just going to knock it out of the park. But then you got to look at that knocking it out of the park that 1 or 2 times during the month has to pay for all of your other losers. Okay, and that's where people kind of get themselves into trouble here. Okay, so
Mitch, this just
yeah,
sorry to interrupt.
yeah,
I'm just thinking of like I know a couple of our attendees I've had conversations with, and I'm not suggesting that this is like by choice, but in the guru space of online, YouTubers professing that their riches from options. I mean, a lot of people push the zero DTE
yeah,
spy options because they're dirt cheap, you
hmm,
know. But then you got
yeah.
I've had conversations with even some of our guys who are newer, like Carlo's been to the office a bunch of times. I had to beat that out of him because he's fight. Not only do you need and tell me if I'm saying this wrong, but let's say you bought calls on the SPY expire today, right? And you've got whatever your reasoning is. It could be whatever your Bollinger Band. Everyone's kind of doing their own thing. And not only do you have to have the trade go right, like in your direction now, because if you're bullish buying calls, well, now you got to have the trade go right before the end of today.
Well,
So
of
like
course, yeah.
the lottery ticket is like very apt because like you need everything to go right and you need to do that every day. Are you kidding me?
Yeah, no, in fact, that's one of the, in fact, that's another, in fact, you're bringing up actually another mistake, um, or in a sense, because people look at this and they go, okay, well, this is what I'm trying to make every day, and I'm going to put on a trade, let's say I want to put on at least one trade every day. Okay, I'm always telling our subscribers, and of course I tell myself, not every chart, not every symbol, and not every time frame, and not every chart has a setup. Okay, or I should say a valid high quality A plus setup. Okay, and so one way to actually also do this right, let's just say you want to trade the SPY. In fact, let me bring up the SPY right here. And I'll tell you kind of like we can talk about kind of how we would actually perhaps approach this. And I'll even change, let's just say we change this to a time, we change the time frame here. Okay. All right. So right now we're looking at, just so happens, we're looking at a 2 hour chart of the SPY here. Okay. But let's just say we brought this thing down, and let's just say we were going to look at this maybe perhaps on some sort of intraday basis here. So let's just say we look at it and on, let's say, a 15 minute. All right. So first of all, we can immediately see. In fact, let this reset here. Sorry, for some reason this is pausing here. All right, so now we're looking at a 15-minute chart of the SPY. Okay. So one of the things that I would be looking for here, okay, we want to find one, find these kind of supply and demand zones here, right? And as I said, not every chart has a setup, okay? And so as a result, the way, let's like for instance, even like with the intraday trades, and I'll show you some intraday trades in a couple of minutes here, really quickly. Um, but the way I look at intraday is I don't even look at like how much do I profit and lose on a week on a per day basis, but I actually look at it in terms of a week, because this way it gives me permission not to actually have to take a trade during that day, if it turns out that there's nothing there. Okay. It also permits me to create setups where I go, okay, here's my setup, but I'm going to take the setup when it gets to where it needs to be. Okay. And so as a result, I'm not just going to race and dive into a trade. Okay. I'm going to actually have my setup and I'm going to wait for the trade to come to me. Okay. And if it's Monday and the trade doesn't get to me, well, then I have the luxury of then if it gets to me on Tuesday or Wednesday, well, then that's when I get into the trade. Okay. So let's just say right here, if I was going to be looking to perhaps trade the SPY here, okay, what I would actually end up doing here is I would probably drop this down to, let's say, a 5-minute chart here. And what I'm going to be doing would be then to be looking for, something where I'm going to identify a supply or a demand zone. Okay. And then this is where I would get into my trade. Okay. So right here, and let's just move that over here. And so right here, this is an area where where we're experiencing what I referred to before was that exhaustion of buyers here. Okay, notice price consolidates here and then kind of then drops out of there. So that's sitting at around the 558 to 559, 589 level here, from 588 to 589 here. Okay, and so this might be what I would look at in a lower time frame. And this is what a trade setup would actually look like here. So this is how we kind of place our lines, and when, and this is obviously part of, how we teach all this stuff. Okay. But let's just say we would place our lines right there. Okay. That defines our area of supply. And this is where we would express a bearish trade. Okay. And so again, we're waiting for price to return to this region. And then we would be looking for this thing to then drop out of there. And then at that point, okay, our trade would look, in terms of the underlying, it would look like that. And I would probably place my stop somewhere around there. And so essentially now that's kind of what the trade would look like. And so that would be a 1-to-1 move. That's a 2-to-1 move. That's a 3-to-1 move. Okay. But notice we're not there yet. Okay. So at this moment, there isn't a trade. Okay. And so as a result, I need for this thing to rally up here. Now, we might just drop from here. We might not rally up here during the day. And so as a result, I'm not getting into this trade today. Okay. But this is what I would consider to be a quality setup. Okay. And we can even see that there's a little confirmation of our thesis here, because notice price consolidate there. It starts to drop with a great deal of energy. These are very bearish candles. And notice it continues to drop. But notice right here, it actually spiked up and it got rejected right at it, like the very front line there, like touching a hot stove. That lends credence to the fact this is probably a pretty good supply zone there, because we got this little tiny reaction that really doesn't do any injury to what's left in that supply zone there. Okay, so I kind of like this for a 5-minute setup. Okay, but again, we have to wait for price to return here. Okay, and as a result, one has to sort of be patient. Okay, so there's that. Okay, so now that's the thesis for for the trade. Okay, and I'm just looking here, and and the alternative would also be, let's just see that, and there's really nothing, at least on the bullish side, until we go much further down. Okay, and then the because right here there was actually a gap, I believe, that I just saw. Okay,
Mm-hmm.
so right there, there's that gap. In fact, this is the I believe this is the election gap, right? Yeah, that's the
11/6. Yep.
yeah, that's the sixth. Yeah. So right there, there's your election gap there. So there's really for me on the SPY, there's really no bullish trade to be taken at this point because right here, in terms of that supply and demand thesis that I just kind of showed you guys earlier, okay, this is an area where we could think of all of this as kind of tested demand here. Okay, we can see right there was a little demand there, and then came back, it bounced, came back, and it bounced again. Okay, so for us, the way Ryan and I look at charts, okay, there's an expression: the first test is best. In other words, if right here we had a demand zone here, okay, we've now been back here once, we've been back here a second time. So if price comes back here, we would now need this thing to work a third time. Generally that doesn't happen that way. Okay, so for us, there's that supply zone here, and then after that, then there's really no trade on the SPY until until we get a pullback to the origin of that retracement. Excuse me, that origin of that election gap, and there's probably something in here that we could trade. Okay, but meanwhile, but if we think about this thing here, though, this is where we would actually have to wait for price to get there. And will it get there today? Quite possibly. You can see it's already kind of spiking. It's already starting to push, and it only has to go about 2 points. But the point is, we wait for the trade to come to us. And if for some reason, if it doesn't come to us, then we just wait till the next day. Okay. So the way we would kind of look at this is, and I'm going to bring up the platform here, and this is going to kind of go through really quickly. I can kind of show you even the difference of how choosing, let's say, an option that's, let's say, like that's going to expire tomorrow versus, let's say, one that's going to expire on Friday, how different the time decay is going to look. And then we can see essentially, how being a value shopper for time is much better than basically trying to do this on the cheap. All right. So what I'm going to do here is let's look at our expirations. And so we can see we got one here. We have an expiration tomorrow, which is what tomorrow's, what today's Wednesday, right? So we have one that expressed one, excuse me. Today's what, Wednesday? Yeah. So we have this one that expires tomorrow on Thursday. Here's the one, okay, and then we have the next one that expires on the 25th, which is that's on Monday. Okay. So that's essentially going to be our choice. Okay. So I'll kind of give you a comparison of what this one that expires tomorrow looks like versus the one that expires Monday. So what I'm going to do is I'm going to look here, and we're gonna buy. Let's just see here. If we happen to buy this thing, let's say we bought the five, we bought a put. And let's just see here. All right, so here's the one that's going to expire. Let's see. Here's the one that's going to expire tomorrow on the 22nd. And let's just say we bought the 588. All right, so there's the 588. So that means you would be buying it right at the money. Now, if you want to buy it a little out of the money, and you want to do it a little cheaper, sure, you can do that. You could buy, let's say, the 586 or something, or even the 585. You can buy, but the second that you start to really buy these things, let's say down here, yeah, I mean, you could buy the 570 for 15 cents. But that's as I said, that's an incredibly difficult way, because you can see, in terms of delta, okay, you're running, in fact, right here, if you just look at the delta, let's say on the 570, you're running a delta of 30, what is that? It's really small, down here, you're running a delta of like 30. So this thing could actually move. You're hardly going to make anything, particularly off of like of a baseline of 15 cents. Okay, you're going to have to buy like a zillion contracts to even try to make anything on that. It's just a very, very difficult trade. Okay,
And
so
you
let's
need to
just say,
move
yeah,
to go in your, like I was saying before about going in your direction. You need a massive move, like
yeah,
an aberration. Like really getting lucky.
right. And then on top of it, you also have to, um, more often than not, you're going to have to also buy kind of huge quantity. Okay, and that's the other thing. All right. So right here, let's say there's the 585 here. So let's just say we bought that for $2. This is kind of where we can see the effect of time decay here. So right here, we can see that our theta, okay, is telling you you're going to lose 74 cents out of that $2.25 because of the fact that you're buying this tomorrow. Okay. So in other words, by tomorrow, okay, this is an awful tough way that you have to overcome that. Okay. 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 And you're running a delta of 36, just an incredibly difficult trade. Okay. Okay. Now, on the other hand, let's just say even if you gave yourself just a little more time, that doesn't mean that you're going to be in the trade for more time, but let's say you bought some more time. Okay, so what I'm going to do is I'm going to tell it to analyze a duplicate trade here. So I put the same thing up here, but now instead of choosing the one that expires on the 22nd, we're going to pick the next one out. Okay, notice right here, the theta is halved. Okay, theta has now gone, excuse me, theta has now gone from 73.75 down to 35. So it's gone down by half. Okay, so right there, you've now made this, I won't call it an easy trade, but now you've immediately reduced the drag on the trade by half. Notice the delta is pretty much the same. They're both 36, 37. Okay. But right here, just for the fact that you spent an extra 50 cents on time, okay, notice right here, okay, if you're going to be in the trade for one day, okay, you're only going to lose $35 instead of $75. Okay, that makes it a less difficult trade. Okay, so that's what I'm talking about in terms of time. Okay, so that's how it works, even in the case of doing a 1 or 2 day trade. Okay, you're much better off at least buying it out, buying it like a week of time versus a day or two of time. Okay. And then, of course, let's just say we even take this one further. We duplicate that again. And let's say we go out one more expiration. And let's just say here we got the 26th, the 27th. Let's just say we took it out to maybe the end of the following week. Okay. Now the price of your option has gone up a buck. Okay. Basically from 260 to 360. But now notice now the theta, okay, it's immediately now dropped another $10. Okay. In other words, it's gone down about what is that, like 30% or 25% from here down to there. Okay. So this is what I'm talking about, being a value shopper when it comes to buying time. And then of course that also applies for doing a swing trade. Okay. Because imagine if you were going to do a swing trade, let's say you were going to do a swing trade with the SPY, what you could do then is you can, let's just say we were going to buy um, let's just say go out and you were going to do a swing trade, right? And let's just say we were going to buy, oh, I don't know, let's say you buy the 27, okay, November 27th, and then let's say you were also going to then take it out to the end of the year. And here's December. So now you bought this thing out another week of time. So right here, you've given it an extra month. Okay. So notice right here, the November has a theta of 25. Okay. Buy it out for an extra month. Okay. It's only 11. Okay. Now, admittedly, you're paying more over here. Okay. Okay. For the same option. Okay. But again, you're going to get this money back. Okay. Proportionally, you're gonna do so much better. Okay, and this is what I was kind of talking about earlier about being the value shopper of how you're going to buy the Samsung flat screen, excuse me, versus the big box. The same thing here. Okay, so this is what I'm talking about here in terms of buying time. Okay, and that's the thing that people make the mistake on. Okay, and then similarly, also buying them way out of the money. That's the other way that people kind of also get beaten up. Okay, so just to quickly show you a couple of other trades here, and then also kind of show you one, let's say where things, let's say don't go right here. But let's just see here. So for instance, here's a swing trade. So this was Dominion Energy, and we had this a couple of weeks ago, a few weeks ago. And so we were looking at this on the 9th of October. And so price, this was an area of demand. Okay. Right here, we had a drop, what's referred to as a drop-based rally formation. Okay. This is where, again, there was an exhaustion of sellers. Okay. We're waiting for price to now return to this region of demand. And we were expecting at the time there would be another bounce out of here. Okay. And then the other thing what we also do when we set these trades up is we're also looking for where they're available, other odds enhancers that kind of sort of enhance the trade. So right here, if I made a point of talking to her when I presented this during an online session with our subscribers, I talked about how this also had going for it, basically basically looking at this was actually like it was dropping below its lower Bollinger Band here, which would mean that sort of price was kind of be very, very stretched to the downside. Okay, and as we know with a rubber band, the more things get stretched, typically they will have a tendency to snap back. Now, having said that, I would never trade off of a Bollinger Band on its own. Some people do, not us. But when we have something that's very stretched and then it reaches a supply or a demand zone, then that's usually a good sign. Excuse me. So that is this was the setup here, okay? And so this is where we would buy a call. And so when price got back here, okay, this is where we ended up buying a call. So price dug in there, okay? So we ended up, you can see this was on October 15th. So we bought exactly 3 months of time on here out to January 17th. Okay. Okay. And so again, we had no intention that we were going to be in this trade for 3 months. But again, we were value shoppers. We bought a bunch of time because if in fact this didn't just react like that and get this nice really quick bounce, what if it came in here and dug in here, and what if it sat there for 2 weeks? It'll happen. Well, this is why we ended up spending $2.90 on the trade on the K, as opposed to like a buck if we would have done this, because I think what it was, we bought the 55 strike call at 55.65. So when this thing pulled in here, we know this thing was 65 cents in the money, but the option cost 2.90, which would mean, of course, that excuse me, that there was $2.30 of time value in here, because 2.30 plus the 65, that gets you up to the 2.90. Okay, so we spent more on time so that if we got stuck in the trade, we wouldn't get too beaten up by it. Okay, so we can see we got in here at 2.90. Okay, and this is a 1 hour chart. Okay, and so we got in on the 10th of October and we were out on the 15th of October. And I don't know if that includes a weekend or not, but let me just see here, the
I
10th.
believe it does.
Yeah, so we got in on a Thursday and we got out on the following Tuesday. Okay, so we're in there. So basically, this is about what? This is 3 trading days and 5 or 6 calendar days here. But again, we bought enough time so that if we got stuck in there, we wouldn't get beaten up by that. Because remember, we had 3 months to go, and so I showed you before when I showed you that when I showed you this thing here. Okay, when we bought that, the time decay looks like that. Okay, in other words, this is where we would here. On the other hand, where I showed you on that SPY before, that thing that was going to expire in 1 or 2 days, okay, you were here. the thing that was going to expire, let's say in 5 days, you were more like here. And on the other and on the other hand, if you bought the thing, let's say 1 or 2 months out, well, then you were sitting up here. Okay. So again, one one wants to look at this thing, at least in my estimation, you want to look at this from the perspective of being a value shopper, because that actually allows you to create a trading system and having a trading plan that you can actually you can actually say, okay, over the course of a month, I'm going to put on X number of trades, okay, and you can kind of gauge based on your batting average and your risk and reward how much you're going to make each month, because you're not trading like a lottery ticket. You're trading it like a business. What I propose here is that this is treating this like a business as opposed to treating this as a series of lottery tickets. So at any rate, so that's what that looked like there. So again, that's,
Mitch, could I
yeah,
also add just like
sure. Yeah.
if I could add just like the efficiency, the time management and efficiency of this trade on Dominion, which I know this is like he doesn't usually come to the Zooms, but this was Abish's first winning trade from joining. He joined like 2 months ago or something like that. So he made a big deal out of it, and I made a big deal of it with him, just making sure he understood what we were doing and why and all that kind of good stuff. And the when I say efficiency, everyone's kind of overwhelmed by all the information that's out there, right? So like whether it's CNBC on the beginner side or just like YouTube University going from the zero GTE stuff, this person's stuff, and not that there's no credence to everything, but just think of something like this, folks, if you're looking at it and you're using $300 of buying power, $290, okay, for one contract. Yeah, you could do all that other stuff Mitch was talking about, like the dollar, the $100 per contract. Well, yeah, you spent a little bit more money per contract. Let's say you just did one, and you made 130, or two contracts. You made $260 in 3 days doing nothing because the trade just did what it was supposed to do, as opposed to like and the trade didn't have to go it wound up going amazingly. Okay, got that. But like you didn't even need it to go as well as it did, and you still would have made money. So just give that a thought against the like, okay, I'm gonna do this buy, and I'm gonna do this, I'm gonna buy 10 contracts here, 10 contracts this day, and then I'm gonna do this, and you're using the same buying power or even less, and a whole lot more efficiently. And you fight overwhelm that way and indecision or the other beast of it is over trading where you're just constantly pushing buttons. So I just wanted to add that for the audience, and if anyone's watching the recording, there's just better ways to trade. And I would venture to say in our community, I think we have about half the community is in the retirement stage where they're one of our best guys is retired and avid skier. A couple other people are working still, and the uh, truck drivers and all. Poor Gene joins our Zooms while he's driving his truck, and then he does his trades at night. So like I mean that also shows his commitment to actually learning this stuff. But for that purpose, when you're overwhelmed and busy with the regulars of life, you don't want to make trading any harder than it already has to be by having to everything go right all the time. It's one of the reasons why there's a high failure rate in trading versus some other types of things. So I just wanted to add that for the audience, Mitch.
Yeah, no, and in fact, just to finish the thought though, this thing obviously went really well. But what if it didn't? What if it dug in here and it hung out here for a week or two, and then you ended up getting stopped out? Okay, by buying enough time, okay, you would have, let's say, I remember, if you recall, I said that there was about $2 and I think $2.25 worth of time value in here after the 65 cents you're in the money. So it's $2.25 of time value. Okay, if 2 weeks passed before you got stopped out, you might lose 30 cents, 35 cents of time value, which would mean that, you might lose, you might have lost, let's say 85 cents or something on the trade. Okay. On the other hand, okay, you could have bought something, let's say for $1.90, okay, because you bought less time, and you might have lost like almost like all of the time value out of that if that's the case, because by
Wow.
buying very little time, okay, again, I showed you, that graph, okay, the time value would leak out of it much quicker. And so as a result, 2 weeks out of 4, okay, leaks out a lot faster than 2 weeks out of 8. Okay. And so as a result, in one case, you'd lose 30 cents of time. In the other case, you might lose, let's say, $90 worth of time. So you spend a little more on the time, okay, but win or lose, you end up profiting or losing less on the back end, regardless of which whether it works or not. The other thing I'm going to show you really quickly here is, so we were talking about before about treating this as a business. Okay. Okay. The way right here, what this is a spreadsheet that we share with everybody, is basically if you decide you want to make X amount of money in a month, okay, what you can determine is, okay, here's my account size, and here's how much I'm trying to make, and here's how much I'm going to put at risk, okay, and here's what my winning percentage is, and here's what my risk and reward is, okay, and if you kind of punch in all that stuff, it will then tell you, okay, here's how many trades you need to do in order to achieve that, running under the assumption that 5 times you're going to be right and you're going to lose 1 unit. 5 times you're wrong, you're going to lose 1 unit. 5 times you're right, you're going to make 2 units. And then as a result, you're going to be up 5 units. Okay, plus 10 and then minus 5 nets out to plus 5. Okay, if you're trading this like a business, you can kind of do this. On the other hand, if you're trading this like a lottery ticket, okay, there's no way that you're going to have any of these statistics that are going to be like really trackable or that really are reliable, where you can actually build a trading plan. Because all you're doing is you're just buying lottery tickets. And, in the same way, if you're buying lottery tickets in real life, you wouldn't exactly go, well, I need to send my kid to college, so I hope that
Yeah.
lottery ticket comes in. That's not a recipe for planning. Um, this is, okay, if in fact that you treat this like a business and you actually have kind of a simple methodology that you can follow. Okay, and I guess I'll wrap it up here by just kind of giving you guys a quick tour of kind of this is where we convey all of this stuff to our subscribers. So what we do is we have different channels within this environment here, and each one of these cover a specific style of trading. Okay, so for instance, right here we have we've been talking about equities here and options. Okay, but we also, with a number of our subscribers, we trade futures instruments as well. So currencies and the equity indexes and gold and oil and all those kind of things. So what we do is we put up setups and we present setups and we discuss them. So let's say for instance, like right here, okay, this was a setup for the Japanese yen. Okay, and so right here, again, here's one of those areas of demand. Okay, again, there was the exhaustion of sellers that I talked about before. And so when price pulled back into this region, okay, there we got that nice bounce there, okay, over the course of a couple of days. And so that turned out to be kind of an awesome futures trade. Okay, so this is the channel that we present. We present our setups for futures. Okay, and so you can see, over the course of, here's this, for the last few, let's say during November, there's been a whole bunch of setups here, and so we kind of go through and we talk about these, and we present all the charts, and then in our live sessions, we then, kind of talk about them in depth. Similarly, on an intraday basis, okay, we have intraday trading of stocks, and so these are generally we're actually buying, and for the most part, these are generally cheap, kind of cheaper, primarily cheaper share prices, either like in the mid or high single digits, and then occasionally 15, 20, 30, $40 shares. But generally that's what we're kind of that's generally what we're doing here. Okay, and so right here again, here's a setup there. Okay, and again, we got the bounce out of that. Okay, and so these are all kind of like a lot of these are intraday trades here. Okay, and then we also talk about how we manage these trades here. Okay, so that was something that we actually did. It was an intraday trade. Okay, it came off of a daily chart. but then we actually broke it down to a 5-minute chart, and we kind of took our subscribers through how we managed the trade as it was going on. Okay, so that's our intraday channel. Okay, and then but primarily these are all kind of these are setups that are all kind of based on smaller time frames. So for instance, like right here, FNA, okay, we can see right there, this was a 2-minute chart here. Okay, so we had this area of demand. Again, we had a drop-based rally formation. Okay, right here we had our exhaustion of sellers. When price returned to this region, okay, what got left in its wake, there was only demand because the supply of shares left there. There was no longer a supply of shares. There was only demand. And so when price pulled back here, okay, it started to bounce. It then came back. It changed its mind, and then it finally launched from there. Okay, and so we ended up getting in here, and it actually went as high to that we were kind of I was setting a target here about 1060, didn't quite make it there, and so when it pulled back here to the 2-to-1 range, that's when we pulled the plug. Okay, so we got in at 10 and we got at 1040. Obviously, that's a 4% gain in terms of the share price. And in terms of our risk reward there, that was a 2-to-1 trade because we had precisely 40 cents of risk there. Okay, excuse me, 20 cents of risk there. So that's a 1-to-1 trade. That's a 2-to-1 trade. Okay, so that's our intraday channel. And then lastly, we also have our, okay, here's where we primarily put all the option setups. Okay, and so, you saw 2 or 3 examples of those. These all get posted in here. One of the things we also do, in addition to buying puts and calls, when earnings season comes around, we also selectively place straddle trades as well, in terms of betting on the earnings announcement, and that's a different level of analysis. You're buying a put and you're buying a call at the money, and you're basically just waiting for the earnings announcement to come out. And those we do on a selective basis after analyzing the history of those. Okay, so but then also, of course, we're also just kind of putting on various just straight buying puts and calls. Okay. So for instance, right here, here was General Electric. Okay. Right here, there was a rally formation. Right there again, this is where price consolidated. Notice right there that explosive candle there. Okay. That was a bullish move out of there. And so again, okay, when I was looking at this, and we had posted this, a couple of days before that. Okay. But this is where we were waiting for price to return to that region in order to then wait for the trade to come to us. Okay, so right here, this is what we were looking at in terms of waiting for the trade. Okay, so that was on October 29th, a couple of days before Halloween. Okay, so right there, we were waiting for price to return there, and then when we put this up, okay, in fact, this is actually the details about doing a vertical credit, excuse me, a vertical spread on this. Okay, and we talk about that with our subscribers as well. So in terms of buying puts and calls, we do that. We also will, occasionally do a a debit spread. Okay, so these all get posted in this channel here. Okay, and then what happens is once the trade is over, there is then a summary that gets posted, in terms of the results. So all of that stuff gets posted in this channel here. So, okay, so for instance, like right here, okay, so here's a Hims. I'm sure you've seen these commercials all over for these guys. Okay, so this was an area again we were waiting for price to return here. Okay, some people expressed this trade. I remember talking to people about this. Some people just did this with the stock. Some people bought calls. Okay, so one could express the trade however you wanted. Okay, and at that point, though, again, price came into this region. Okay, and so we were looking at this. This was on what is that, August 28th, and then trade actually triggered. You can see that didn't trigger for about 3 weeks. Okay, on the 13th of September there. Okay, so but we had this in our pocket, and we're just waiting for this to come back to us. It kind of looked like it was going to get there actually pretty quickly, but in fact, what happened was, you can see that was what we were looking at, and then it actually took its sweet time. and this is a daily chart. So this kind of just drifted down over the course of about a week and a half, and then we got this nice pop here. Okay, so some people just did this with the stock. Okay, okay. On the other hand, some of us um, bought calls. So you can see on September 6th, okay, and we ended up buying the January. And I think the reason we bought this so far out, we didn't really need to buy it that far out. But I think what happened was there was an October expiration and there was a November, but there wasn't a December. And so as a result, when this thing was drifting, generally I like to be in the trade and have really, I really don't want to drop below 50 days. Okay. It's just, I mean, you could certainly do less, but when you don't drop below 50 days till expiration, basically time decay is generally not that big a deal. I mean, it's certainly, I shouldn't say it's not that big a deal. It certainly is going to drag on the trade, but it's going to be a much lighter drag on the trade than if you buy it out, let's say 3 or 4 or 5 weeks. Okay, and so as a result, I think waiting for this thing, because one of the things is we don't really know when this is going to pull back. So when this thing actually pulled back, I think I looked at the options and I just figured out that the risk and reward on this was going to be best buying the January versus buying the November. And I think that's why I ended up selecting this. So when we got in for $3 and we got out at just south of $5. Okay. So this was obviously, pretty much buying basically a 65, 66% rate of return on that going from 3 to 5, basically. So that was, obviously a good trade. But and here and there, there are definitely losing trades. But again, if when we had losing trades, let's say if they had dropped to here, we would have lost, 56, we would have lost 50, 60 cents, 70 cents, something like that. On the other hand, when we got to here, you can see what we made. And in terms of, the risk and reward, you can see, in terms of the underlying, this thing went up about, just about 3 to 1. And we ended up, making that on buying the call there. So that's what that channel looks like. And again, that's pretty much where all of our um, equity trades are, both stock as well as swing trades in terms of stock and options. And then the last primary channel for us, for everybody, is the community channel. Okay, and so this is where things get posted, just in terms of people, discussions that people have, and people, we put up stuff. It's no, this is where we generally put stuff that's not an explicit setup, but these are things that are people discussing. Okay, so in other words, right here, this was something where we were looking at a chart of Occidental Petroleum, and this wasn't even an explicit trade. Okay, but what it was that this was something we had discussed during a session. We didn't actually take a trade on it. Okay, but it was actually an illustration, though, of I was showing people how price basically bounced between supply and demand. Okay, and so well, like a lot of our education stuff goes into this community channel, and then just people put up all kinds of interesting stuff, and people share their charts. And we also had something where we found, interesting information sources, all kinds of stuff. So that all goes in there. So there are 4 major channels here. Okay, we have the futures channel, we have our intraday stock setups. Okay, we have our the futures, the stock and the options, and then lastly we have the community channel. Okay, and then of course, people can DM us and all that stuff, and so everyone shares. We have a community. There's a whole lot of idea generation there, and it's a good group. So at any rate, that's kind of the whirlwind tour there.
Cool. Well, good stuff. I hope we dispelled a decent amount of myths, most importantly, and then obviously showed you how to address overwhelm by going from, uh, one way people get themselves overwhelmed is because they choose to be overwhelmed. So hopefully following some of the guidelines in what Mitch discussed, and me to a lesser extent, hopefully puts you on a little bit better path than you were before. So I'm hoping that helps quite a bit. And then if you guys need more help and would like to see more about our community and how we can help you, be uh, calm and confident trader as opposed to like the overwhelm that you're dealing with now, go ahead and you will see a calendar link. It'll be actually in the email you're going to get right after the session. And then feel free to set up a time for us to talk. A bunch of you know me already, so you getting to me isn't that all that hard. And if you'd like to discuss anything with Mitch, that's fine too. Let me know. And then we're going to call it a day here. We went a little long, but we had a couple of good questions. With that, we'll call it a day. If you arrived a little bit late, I am sorry. I wasn't planning on giving out the recording, but maybe I will just because we had a couple of late arrivals. So yeah, if you missed the beginning of this where we kind of broke it down step by step, fear not. This takes about an hour to process or so, and I'll get it out after the close today. I have some appointments after this, so sometime tonight you'll see it in your email inbox. And if you got this invite, you'll get this. So with that, let's call it a day. Mitch, thanks for a great talk today, and we'll see everybody next time.
My pleasure. Take care, guys.
Bye, guys.